Welcome back, everyone, for another deep dive. Today, we're looking at insider trading, a recent paper called Reverse Timing of Insider Trading. It asks a pretty interesting question. Can corporate executives manipulate the timing and content of information they disclose to benefit their stock trades?
Yeah, and they can do this even when they're supposedly following the rules. We're talking about SEC Rule 10b5-1 plans.
Exactly. The ones that are supposed to protect them from insider trading accusations.
Right, because the rule lets executives pre-plan their stock trades. The idea is if they set up a plan in advance, well, they couldn't be using insider information because they wouldn't know about it yet.
Yeah, you'd think so. But this paper suggests that some executives might be finding ways around that.
Oh, yeah. They might be timing the release of good or bad news to impact the stock price right before their trades are executed.
They're kind of like creating their own little market advantage.
That's exactly what it looks like. And to figure this out, the researchers analyzed a ton of data on insider trades. And you know what they found? Some really interesting patterns.
Oh, I bet.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So how did they go about this whole thing? What was their approach?
Well, first, they classified insider trades in two ways. First, was it pre-planned under this Rule 10b5-1, or was it not?
Right, because that's the whole point of the study, right?
Exactly, that's the heart of it. But they also categorized trades as either routine or opportunistic.
Okay, so routine, meaning like regularly scheduled trades.
Exactly, like clockwork. Think of an executive selling a set amount of stock each quarter.
Got it. So then opportunistic is everything else.
Exactly. Trades that kind of come out of nowhere and don't follow a regular pattern.
Okay, so by looking at both types of trades, did they discover if this manipulation was happening even in those seemingly ordinary trades?
Yeah, that was the idea. To see if there was a broader issue here, not just a few isolated cases.
Smart. So what'd they find? What kind of patterns popped up?
One of the most interesting things they found was this concept of reverse timing.
Reverse timing. I'm intrigued.
So it has to do with how stock prices move around these insider trades. They noticed that, say, when an executive sells stock under a 10b5-1 plan, well, the price tends to go up before the sale and then down afterward.
Hold on. So they're selling high and then the price drops. That sounds like they knew something was coming.
Right, that's what it suggests. And here's the thing. This pattern happened with both pre-planned and non-pre-planned trades.
Wow. So even the ones that weren't part of a plan showed this perfect timing.
Yep. And it happened with routine and opportunistic trades, too.
That's pretty wild.
Yeah.
It really makes you wonder if there's something more going on than just luck or market savvy.
Right. So to dig deeper, they looked at the timing of SEC filings, those 8K reports.
Oh, yeah. Those are the ones companies have to file when something big happens.
Something that could affect their stock price, like earnings announcements, mergers, big leadership changes, you name it.
So if an exec knows a positive 8K is coming out, wouldn't it make sense to schedule their trade right before?
Bingo. And that's what they found. These companies were way more likely to file 8Ks before an insider trade than after.
And this was across the board, all types of trades.
Across the board, pre-planned, non-pre-planned, all of them.
Okay, now this is starting to feel less like coincidence and more like a pattern.
Right. It raises some big questions about just how common this strategy might be, but they didn't stop there. They wanted to look even closer at the information itself.
So not just when it was released, but what it actually said.
Exactly. They used something called sentiment analysis to figure out if the news was positive or negative.
Okay, so they weren't just looking at numbers. They were analyzing the actual words.
Right. And that's where things got really interesting. They found that there was way more positive news coverage right before insider sells than after.
Interesting.
And it was the opposite for buys. More negative coverage before they bought stock.
So basically they're selling when the news is good and buying when it's bad.
Exactly. Like they know it's coming.
That's pretty shady.
And here's the thing. This pattern was super strong for news that came directly from the company.
Oh, so it's not just like they're riding some industry waves. They're actually putting out the news themselves.
It seems that way. which raises some big questions about how good our regulations really are. I mean, if execs can manipulate when and what information gets released.
Yeah, then the whole system's kind of rigged, right?
Exactly. It undermines the whole idea of a level playing field.
And how widespread is this? I mean, if it's showing up in this study.
It makes you wonder, right? It's probably not just a few bad apples, so what can we do about it? Well, the researchers have a few ideas.
Lay it on us.
One thing they suggest is a longer cooling off period between setting up a 10b5-1 plan and when you can actually trade.
So you can't just set up a plan and then immediately act on insider info.
Right, there'd be a mandatory waiting period.
Makes sense.
What else?
They also think we should limit how many times an exec can change or cancel their plan.
Yeah, because if you can just keep tweaking it, it defeats the purpose.
Exactly. And I guess the most extreme solution would be to just get rid of Rule 10 B51 altogether.
That's the nuclear option. But some people think it's the only way to really level the playing field.
Wow, so no more pre-planned trades at all.
Nope. Every insider trade would be under a microscope.
That would make some execs sweat.
For sure. But it might be what we need to restore some trust in the market.
Right, because if people think the system is rigged, they're not going to want to invest.
Exactly. And that hurts everyone.
So what does this all mean for the average investor? Should we be panicking?
I wouldn't say panic. Investing is still one of the best ways to build wealth long term. But you got to be informed and understand the risks.
So don't just assume that pre-planned trades are automatically okay.
Right. Do your research. Look for patterns of well-timed trades that always seem to benefit the execs.
Red flags.
Exactly. And don't put all your eggs in one basket. Diversify.
Smart. And I guess stay updated on any changes to the rules.
Absolutely. The SEC is always tweaking things, so keep your ear to the ground.
So vigilance is key.
Always. The more you know about how the market works, the better decisions you can make.
Well said. So are there any, counter arguments to this study? Other perspectives?
Of course. You know, some folks say the study's methods might be flawed, or that they're blowing things out of proportion. Correlation doesn't equal causation, right?
Right. Just because there's a pattern doesn't mean every executive is doing something wrong.
Exactly. Maybe they're just good at their jobs, or lucky.
Right. Maybe they just have a knack for predicting the market.
That's possible. But the researchers did try to account for those things in their analysis.
So even after taking that into account, they still saw these suspicious patterns.
They did. Now, of course, we need more research to prove anything, for sure. But this study definitely raises some eyebrows.
It does. It reminds us that things aren't always what they seem in the world of finance.
For sure. There are always hidden currents to be aware of.
Absolutely. Before we wrap up, I want to circle back to one thing. The study specifically looked at the period before insider trades happened. Why was that so important?
Right, because remember, we're trying to see if execs are releasing info to move the stock price before they trade. So by looking at what happens before the trade...
Yeah, you can isolate that.
Exactly. And that's where the results get really interesting. They found a lot more of those 8K filings.
Right.
And a lot more positive news coverage before insider sells, especially for news coming straight from the company.
It really does look like they're priming the pump for their trades.
Yeah, and remember, they used sentiment analysis to look at the actual tone of the news.
Right, not just when it came out, but what it actually said.
Exactly. So if they're always putting out good news before they sell and bad news before they buy...
It's not just a coincidence.
Definitely makes you think.
So it all comes down to motivation, I guess. Are these execs just trying to hit their performance goals, or are they just greedy?
It's a good question. And it raises some bigger issues about corporate governance and ethics. I mean, if execs are willing to manipulate information like this...
It makes you lose faith in the whole system.
For sure. It erodes trust not just in the companies, but in the market itself.
Yeah, this isn't just some theoretical problem. This has real consequences for everyone.
Absolutely. It impacts investor confidence and market stability. Big time.
So what can we do? We talked about longer cooling off periods and limiting plan changes, but is that enough?
Those are good first steps.
Yeah.
But we might need to rethink insider trading regulations altogether. Maybe move away from this whole pre-planned trade system and focus on stricter enforcement and tougher penalties.
Yeah, make it riskier to break the rules.
Exactly. But no matter what happens, investors need to be aware of this issue and do their homework.
Don't be naive.
Right. Keep an eye on insider trading patterns. Diversify your investments. Knowledge is power.
Couldn't have said it better myself. Well, this has been a fascinating deep dive into the world of insider trading and just how sneaky it can get.
Absolutely. Always more to learn.
Always. Thanks for joining us. Until next time, keep learning, stay curious, stay engaged.